Welcome to Skills for Success Financial Literacy Part 1, presented by Big Brothers Big Sisters of New York City. My name is Caitie, and I'm excited to explore financial literacy with you today. Before we begin, please complete the Financial Literacy Part 1 pretest if you haven't already. Now, think about your response to the pretest questions and reflect on your money management knowledge and skills. How comfortable do you feel making decisions about your money? How would you rate your ability to manage your finances? Hopefully, after this time together, you will better understand your finances and feel more prepared to make decisions about your money. Today, we will introduce key financial terms and learn how to manage your money responsibly. During this webinar, you will use all of this information and your critical thinking skills to respond to a few scenarios and tackle your own finances. In order to meet these objectives, we've broken financial literacy down into 3 components: budgeting, savings, and credit. In this webinar, Financial Literacy Part 1, we will focus on budgeting and savings. The following webinar, Financial Literacy Part 2, will explore credit. So what is financial literacy? Financial literacy is the ability to use knowledge and skills to make effective, responsible, and informed money management decisions based on your personal spending and savings habits. Let's start with budgeting. What is a budget? A budget is an outline of income and expenses that is both accurate and realistic. There are many different budgeting strategies we will explore later, but all effective budgets meet the criteria of being accurate and realistic while ideally helping you reach your financial goals. Why do we budget? As I mentioned, you probably have some goals. Many of your personal and professional goals have a financial component, like going to college or technical school, starting your career, moving out, buying a car, buying a home, or starting a family. All of these require money. A budget helps you plan for expenses, cut spending, spend wisely, save for future goals, and develop lifelong money management skills. Think of budgeting like a financial roadmap that will help you feel more prepared for future expenses. Needs versus wants. As you begin creating a budget, you must differentiate between needs and wants. We have basic needs that must be met in order to survive. These are food, water, shelter, and clothing. We also have some needs that we must meet in order to complete tasks like school and work and function in society. These include things like grooming products, appropriate clothing, transportation, school supplies for students, or work or career-specific needs like non-slip shoes for food service or licensure in your field. On the other hand, wants are things that we don't really need but would like to have. Examples include video games, a new phone, new or trendy clothing, meals out with friends, and I'm sure you can think of many more. Differentiating between needs and wants helps you build a budget that allows you to meet your needs, enjoy some of your wants, and work towards your financial goals. Types of income. In order to build a budget, you need to understand income and expenses. Today, we will talk about 2 types of income: gross and net income. Gross income is the amount of money you earn before any taxes or deductions. Gross income is often the salary that you are offered for a position by an employer. conversely, net income, is the amount of money you make after taxes and other expenses have been subtracted. For an individual, net income is often called take-home pay because it's what you take home after payroll taxes and retirement contributions have been subtracted. Therefore, you want to create a budget based on your net income, not your gross income, because your net income is what you will have in your bank account on payday. Similarly, your budget will include two types of expenses, fixed and variable. Fixed expenses do not change. They stay the same from period to period. For example, your rent or mortgage, and in some cases utilities, will not change from month to month. Variable expenses, however, can change. You may spend more or less from month to month on things like groceries, personal hygiene products, clothing, gas, etc. What goes into a budget? Here's a list of monthly expenses separated into fixed and variable expenses. Here we have highlighted rent, utilities, and transportation as fixed expenses. We've highlighted food, entertainment, and vacation spending as variable expenses. Can you think of any expenses that are not on this list? If so, are they fixed or variable? Meaning, do they stay the same or change from month to month? When you begin to make a budget, you can list out all of your expenses and determine what is fixed and what is variable. This will help you assess your spending to build an accurate and realistic budget. In order to manage your money effectively, you need to know where it's going. Once you have a list of your expenses, you can add up your spending and then compare it to your income. Now you can see this individual's monthly spending compared to their income. Here, they make $3,034 per month after taxes and retirement contributions have been subtracted. They spend $2,000 per month on rent and insurance, $500 per month on food and household items, $500 per month on utilities and bills, and $400 per month on extras, leaving them with a $366 deficit. A deficit means that this person is spending more than they are bringing home. Why is this a problem? If this person has a budget deficit, meaning they spend more money than they actually have, they are likely accumulating debt. Let's look at several real-world budgeting scenarios. In this activity, we will read about two people who are struggling to meet their financial goals, and we'll analyze their budgets to determine what they can do to get back on track. Scenario 1. Nate is a junior in high school. He works 15 hours a week at the mall, and his net income after taxes is $600 a month. He lives with his parents, so he doesn't have rent, utility, or food expenses. His older brother owns a car and lets him borrow it to drive to work. In return, Nate pays his older brother for gas each month. Otherwise, Nate takes the bus. Nate really wants to buy a car, so he puts any leftover money towards savings. Nate also pays for his cell phone and personal expenses, such as going to the movies, buying video games, and purchasing gifts. Where is Nate's spending getting off track? And what would you recommend Nate do to reach his goal? Let's take a look at Nate's budget. You may notice that Nate's budget goals and actual spending do not align in any category. As we discussed, an effective budget is both accurate and realistic. Let's first look at Nate's fixed expenses. Nate should adjust his budget goals to match his actual spending in the fixed expenses category. Unless Nate can negotiate with his brother to lower his car payment or find a cheaper phone plan, these expenses will not change, and Nate's budget should reflect that. Next, Nate aims to spend $50 on public transportation, but spends $60. If Nate can reduce his public transportation use, he could meet his goal. But if this is not reasonable or feasible, Nate should adjust his budget to match his actual spending. Finally, Nate spent $15 more than budgeted on entertainment, $125 more than budgeted on personal shopping, and $75 more than budgeted on occasional spending, or what we'll call miscellaneous. Now, let's adjust Nate's budget so that it is both realistic and helpful for reaching his financial goals. In his original budget, Nate budgeted $400, but we know he has a net income of $600 per month, so we will budget all $600. Any excess that Nate does not spend can be added to savings at the end of each month. In our proposed new budget, let's say that Nate is not able to lower his cell phone, car, or public transportation expenses. Here, we match Nate's actual spending in those categories and also budget $60 in entertainment, $100 in personal shopping, and $80 in occasional spending, so that Nate can still spend money in these categories while working towards his financial goals. In our proposed new budget, Nate will save $100 per month for a car, staying on track with his financial goal. Scenario 2. Maria just graduated from college and accepted her first job as a social media manager for a real estate company. She can't believe that her monthly net income will be $3,000. She just moved into a one-bedroom apartment, so she is responsible for rent, utilities, food, and other expenses. Maria is paying off a student loan, and she wants to save as much money as she can to buy a house someday. Maria owns a car and enjoys going out with friends on the weekend. Let's explore how we can correct Maria's budget deficit and help her reach her financial goals. Again, we will start by looking at Maria's fixed expenses. Maria should budget the same amount for her rent, car payment, insurance, internet and cable, cell phone, and student loan bills each month. It appears that Maria has budgeted accurately in all fixed expense categories except for her phone bill. Like we discussed in Scenario 1, unless Maria can find a cheaper phone plan, her budget should reflect her actual monthly spending of $105. Let's move on to variable expenses. Maria spent more than budgeted in the following variable expense categories: $75 over budget on gas, $50 over budget on food, $150 over budget on entertainment, $225 over budget on personal shopping, $75 over budget on utilities, and $100 over budget on occasional spending or miscellaneous. Here is a new budget for Maria that would allow her to spend money going out with friends on the weekend, as the scenario stated Maria enjoys, while also paying off her student loan and saving for her future home. In our proposed budget, Maria would need to spend $25 less on gas by walking, biking, or carpooling when possible, and use her utilities mindfully to lower her utility bill by $15. Maria would also need to decrease her personal shopping and entertainment spending significantly. With Maria's goal of saving $450 per month for her future home, she has a limited amount of money to spend on non-essentials or wants. If Maria is not able to make her actual spending match her new budget, she may need to reevaluate her goals and consider lowering her monthly saving goal slightly to give her more flexibility while she pays off her student loan. However, it is possible for Maria to reach her savings goal of saving $450 per month for a house if she is willing to lower her entertainment and personal shopping spending significantly. Great work! Now, let's talk about savings. Types of savings. There are 3 types of savings accounts you can utilize to reach your financial goals. First, everyday savings accounts are linked to your checking account and are useful when you are saving for upcoming trips, special events, or large purchases. For example, if you know you want to go on a trip with friends after graduation or buy a TV for your dorm room, you can easily move money from your checking to savings account to prepare for these purchases. Next, emergency savings accounts are critical during unexpected life events. When you start building a budget and setting your financial goals, saving 6 to 12 months of living expenses is the first step to establishing your financial security. Finally, retirement savings accounts like a 401k, 403b, or pension cannot be touched until you are of retirement age. After building an emergency savings account, putting money away for retirement is the best thing you can do as a young person for your financial future. The earlier you start saving, the more money you will accumulate in interest. Saving for retirement. Individual retirement accounts, or IRAs, allow a person to contribute up to $5,500 in pre-tax earnings per year. Your contributions are tax deductible, and your money is taxed at your income tax rate at the time that you withdraw it. Conversely, a person contributes to a Roth IRA, also called the IRA Plus, after taxes. So the amount you contribute is taxed when you earn it, not when you withdraw it. Meaning, if you expect to be taxed at a higher tax rate when you retire than when you're saving, meaning you are in a higher income tax bracket when you retire than when you're saving for retirement, it would be wise to contribute to a Roth IRA. When you contribute to a Roth IRA or IRA Plus, your annual contribution is not tax deductible, but the interest you earn on this account is tax-free after 5 years. You can withdraw funds from your Roth IRA after age 59 if you are disabled, if you have educational expenses, or if you are purchasing your first home. Saving for retirement. Employer retirement plans can include 401ks, 403bs, and pensions. A 401k allows a person to contribute to a savings plan from his or her pre-tax earnings, reducing the amount of tax that must be paid. Employers often match contributions up to a certain level. A 403b plan is a retirement plan for some employees of public schools or tax-exempt organizations. A pension is a retirement account that an employer maintains to give you a fixed payout when you retire. Your payout typically depends on how long you worked for your employer and on your salary. Make sure to ask your employers about these retirement plans if they are not offered to you. Now, it's your turn. In a moment, you will compile a list of your needs, wants, fixed and variable expenses. Use the lists and sample budgets in the previous slides as guides to see a snapshot of your spending. If you use a debit or credit card, it is helpful to view your statements to understand how and where you spend your money in any given month. Also, try to list all of your cash transactions from the past month. Once you know your actual spending, you can build a budget that is both realistic, accurate, and helps you reach your financial goals. Locate the Personal Monthly Budget activity in the Google Classroom to begin building your budget. You should know that there are also many budgeting apps, such as Mint Budget, Pocket Guard, and Every Dollar, that are easy to use and can help you create an effective budget. So, If you know that you're more likely to use and regularly check an app than a document or spreadsheet, do that instead. The key here is to use whatever method works for you. You made it! Now you have the knowledge and tools to budget and save. You're ready to take the post-test and work towards your financial and personal goals. Please complete the survey and develop your own budget using the activity in the Google Classroom. When you're ready, proceed to Part 2 to learn more about credit. Thank you.